thank you very much. I understand it's the middle of the afternoon, so we're going to try to keep your attention for as long as we possibly can over the next 30 minutes. I'll ask my esteemed panelists to please introduce themselves and tell you a little bit about what their businesses do. Antoine?
Hi. Yeah, sure, I'll start. So I'm Antoine Lorteau. I'm a partner and head of France for PartSquare Capital. We're a private credit fund with about 12 billion euros under management.
Thanks. Jeff Fogel, I'm a managing partner with CourtSquare Capital. I lead the technology investment effort there. We are a US middle market buyout focused fund, currently investing out of a fund that's roughly 3 billion in size.
I'm Marc Frappier. I'm an executive board member with Eurazeo. I'm heading our buyout strategy. Eurazeo is a 32 billion asset under management alternative manager in Europe. We're managing close to 10 different investment strategies ranging from private equity, private debt, and real assets.
And I'm Sunaina Sinha. I'm the Global Head of Private Capital Advisory at Raymond James. We're a placement agent and secondaries advisor on a global basis. So I don't have to tell you all how dismal the economic outlook is, how tough 2022 was, what the public markets have been doing. And, well, what we do know for sure is that deals seem to have slowed down quite a bit in buyout world. So let's start with you, Jeff. Tell us a little bit about how your pipeline's doing. How are you thinking about what goes in the top of the funnel and whether that screening criteria has changed?
Yeah, way to start off with a negative tone on a terrible market. In reality, if we can provide a little bit of optimism, it really depends on what is the priority of any given manager. For us, we are very much focused on growth businesses, but growth businesses with strong cash flows, and that's going to be very important in times of uncertainty. For us, and I think that what you'll start to see is this developing for lots of funds within 23 and beyond, is being very thematic in our approach. We're chasing long-term growth trends that are undeniable regardless of if there's a pandemic or there's geopolitical uncertainty or there's rising interest rates or wage inflation. These trends are going to be growing regardless. And for us, since I'm on the tech side, it's cybersecurity, for example, or growth in bandwidth, proliferation of devices. These are long-term trends. You can get behind those. And from there, it's incumbent upon us to really invest behind strong management teams and platforms that we feel that we as CourtSquare can add value and differentiate in their growth.
Marc, are there types of deals that you're dialing up or dialing down when they come through the door through advisors or networks?
Well, I think I would echo what Jeff just said. I think what is important is to rely on fundamental value creation trends, and obviously focusing on the right themes, the right sector is absolutely paramount. So we're focusing on long-term trends around digital transformation, around healthcare topics or emerging fintech themes, and this is one aspect that makes us comfortable through the crisis. So the selectivity and the discipline you bring in your investment process is absolutely paramount.
Antoine, you work with sponsors, dozens of them. Have you noticed a slowdown in deployment cadence?
Well, I mean, being on the credit side, 2022 has actually been a pretty good year for us. I'd say we haven't seen a slowdown, to be fair. What we're seeing is a slight slowdown in terms of the public-facing public auctions, because the M&A, public-facing M&A is probably a bit slower. But the reality is that people don't just come to us for primary deals, primary transactions. We get called upon for refinancings, for add-on financings. And one of the very big themes we're seeing with sponsors right now is the focus on the portfolio and how sponsors are very adamant to finding ways to create value within their portfolios through add-on acquisitions and things like that. So that really keeps us very busy at the moment.
Yeah, I was just going to add to that. In terms of deal activity, what we are finding, I think from numbers of transactions, certainly the last couple of years have been peaking in terms of markets, so it's not going to hit the same level. There's a real flight to quality, though. And the businesses that we're taking out to market that we see, they're going to be the ones that are going to trade regardless. And if it's a business that has some fundamentals that still need to work on, you're just not seeing those come to market, which for us is fine. You want to be going for strong platforms regardless. but that's ultimately what's going to get financed as well.
So, Mark, how do you do a deal in this challenging environment? So, let's talk a little bit about underwriting. So, let's start with the big punchline of underwriting, which is valuation. Bid-ask spread, is that still pretty wide? Are things clearing? As Jeff said, are the high-quality businesses always going to command a price? How are you thinking about that big V word?
No, so there's different aspect to your question. One is, the underwriting itself, which is what are you underwriting in terms of investment themes. So we talk about the macro themes, but then it comes down to asset selection. So within that theme, make sure you back the right company with the right market share, the right strategic positioning, and therefore you have confidence in this company's ability to create value over the long term, have pricing power, have good margin, good cash flow generation. So the fundamentals and the discipline you bring within your investment committee is paramount in terms of underwriting. So we build and we spend a lot of time, especially with our operating partner team, to challenge the deal team's assumption, making sure we don't fool ourselves with what are the growth rates, what are the margins improvement you're looking for, and especially what are the upsides. And we're looking not only at what the business is today, but what the business could look like tomorrow. And this is a big piece of our underwriting, is where do you see M&A opportunities? Do you see new product? Do you see new TAMs that are not being addressed? And so if you put all that together, that creates a funnel of opportunities, and that creates a distribution of outcome that becomes relevant, and that needs to be something realistic. And we spend a lot of time with our operating partner team making sure it's realistic. So once you have that, that's the basis on which you can write the price and based on your expected returns. And this is where the market transact, because for good quality assets, you find the right equilibrium in terms of valuation. For assets that are more difficult to underwrite, where it's more difficult to put a price on it because the value and the growth is more certain, this is where the market is harder to bridge. So it's really two-tier market. High quality assets, easy to underwrite, high conviction, they transact because the bid-ask spread is shorter. For the other one, it's a much wider bid-ask, and actually deals are not transacting for now.
Indeed, I think a lot of our M&A colleagues will tell you they're just not bringing those deals to market because they know they're not going to clear. Jeff, tell us about stress tests, base case and downside case scenarios you're running in this market. And then also tell us about structuring, right? Are you seeing more earnouts? Are you seeing other ways to give some downside protection when it comes to entering these deals?
Yeah, the one thing I was thinking about when couldn't agree with Mark more in terms of this is the beauty of private equity. We're buying in a time of uncertainty, certainly, but these are long-term holds for us. And it's incumbent upon all of us, when we buy these businesses, what can we do with them? How can we drive value? And so the stress test, to your question, certainly on any given underwrite, we're going to look at some type of either downside scenario, recession case, you name it. Lots of times with businesses, our businesses can track back to the financial crisis, and you can see how the business performed. For the most part, we're going after strong business models that have high recurring revenue, so they're going to be fairly resilient from that standpoint. So for us, really what we're looking at doing is what can we do with that business? How can we drive efficiencies? How can we scale that to 2, 3, 4 times its size? And yes, can it be resilient in a downturn? Fine. That could also be buying opportunities for us. So greater than 80% of our portfolio, we do at least one add-on acquisition. In markets that are a little bit choppier, you're able to buy these businesses for far more advantaged rates that can drive value long term. So I think that answered the first part of your question. What was your second?
Yeah, the second part of the question was, as you think about stress testing and downside planning in this market, are you doing more of that today than you were a couple of years ago?
Really, you also asked a question about structure, I think. So yes, the last 2 years, quite honestly, since COVID, we've been running regular stress testing throughout the underwriting aspect. So that's going to continue for us, but that's just to get us comfortable with the asset and what we can do with it. And then ultimately, I think, and you'll get into this later, but I think for 2023, just to be able to deploy capital, especially if it's some more challenged environments, you're going to see a lot of folks structuring their deals a little bit more just to be able to give them that protection. For us, we don't do as much of the structuring there, but we do it on the earn-out side, to your standpoint, and that's primarily through the add-ons. Significant amount of earn-out just to say, all right, if you truly believe that you can hit that, we'll be willing to pay for it. And fortunately, our companies are doing really well, so we're finding out for 2023, we're paying out a lot of earn-outs, but that's phenomenal. It's because our companies are executing. So.
Antoine, private credit, your market has never been more important. Let's be honest. In a world without leverage, you are the leverage. So tell us about how your underwriting has changed. What are you scrutinizing more today? What are the covenants looking like? How has your deal underwriting evolved over the last couple of quarters?
No, that's a good question. Look, I think the fundamentals of our underwriting hasn't actually changed that much. We've always been very focused on fundamentals. We've been focused on making sure we invest in companies that have very strong barriers to entry, that have strong pricing power, which is especially important right now in a rising inflation rate environment, that they're in a solid position in the value chains in which they operate, that they generate strong cash flows. And so more than ever right now, we're very focused on making sure that these things continue to apply. What has changed in the underwriting is more everything having to do with the market around us. And what that means in practice, it's different structuring, which typically will involve more conservative levels of leverage. It's going to be more conservative documentation. I mean, obviously I'm a bit biased if I say this, but our view is that the documentation was pushed to levels which didn't really make much sense anymore, and it's being reined into levels which probably a bit more in line with where they were historically. It's also true on pricing, and so all these things have come together. And so now, the assets in which we invest in aren't fundamentally different. We continue to look for high quality businesses that that are going to have good downside protection, which will be able to fare well in potential downturns. It's just that the overall package has become more attractive.
Jeff and Mark, this is a question for both of you, because not just when you're buying businesses, but also when you want to think about selling anything in your portfolio in the near term, how do you do that in a very leverage-constrained environment that we're living in today?
Well, it comes back to your underwriting question, is if you make the right asset selection and you do your work from a value creation perspective, you end up with better quality assets that are larger, more diversified, more environmental friendly, and they have a lot of attributes that make them more appealing to new buyers. So you're in a better place to sell your business. Again, if you do the right choice in terms of underwriting, and therefore, these businesses are able to transact because despite the higher cost of debt, if you have debt that costs anywhere between 7% to 10, 12%. You need value creation engines on top of it that are high double-digit growth. And so this is what we can provide to the market, and therefore we're confident that we'll be able to sell our assets at good prices because debt becomes irrelevant. This is not what drives value, and this is a small headwind versus the fundamental value creation of the assets.
I think to add on to that too, the majority of our deals are in the middle market, and so within the U.S., that means that the majority of those, when we're exiting, it's reliant, if it's not a strategic purchase, which half of ours are, it's reliant upon the direct lenders. And the direct lending market is still quite vibrant. It's to the case where we've scaled a business to maybe 200, 300, 400 million of EBITDA. They are reliant upon the broader syndicated debt market, which is very choppy in the US right now. So for those companies, even though they're doing really well for us, you may see us just, rather than exit now, why would we do that within a choppy market? We'd prefer to hold it, keep growing value, and then sell it in a better syndicated side. But that's a little bit to a lesser extent for us since we're in the mid-market.
And just to add to Jeff's point, some of the transactions we've been doing recently are actually private add-ons to syndicated deals, which, look, we know is completely representative of the fact that the market is as it is currently, and that the banks are quite shut, and that the secondary market is trading at a discount to face value. But the reality is that for us and for the good companies, sponsors have been able to finance very compelling acquisitions by asking us to provide private capital to tap alongside the existing syndicated debt structure and allow them to make to put in place their equity strategy as planned.
Antoine, if I can come back to you, you mentioned ongoing portfolio monitoring, which is the other big challenge and certainly a huge part of what all three of you would do on a day-to-day basis. Are you noticing any portfolio trends that are interesting for you right now, or you think that it's all about tightening growth and seeing where that comes out in 23?
Look, our portfolios are doing very, very well. I think it's a testament to, to our conservative underwriting. What I would say is that the top lines generally are doing quite well. We are seeing instances of some compression on profitability, typically in cases where companies have not been able to raise raw material, have not been able to raise prices quite in line with the increase in raw material costs. It comes down to something that we look at a lot in our businesses. I mean, we focus on two main things: ability to pass through prices and the impact of rising interest rates. And so we run a bunch of sensitivities on a portfolio in different cases, and we try to make sure that always works. We do that as we are about to enter a deal, and we continue doing that while we're invested in a company, just to make sure that companies continue to perform well.
Mark, you hear a lot about earnings recession, right? You turn on CNBC or Bloomberg. If you don't hear those two words within the first 5 minutes, you haven't gone to a business channel. How do you think about the earnings impact of the macro environment in your portfolio, and how are you shoring the companies up for that?
Well, we're not, doing macro plays, right? So we're doing stock picking, and we're down to the quality of the asset. So again, this is the paramount aspect of making sure you back the right companies, and you make sure that while doing that, you anticipate issues. And so we're spending a lot of time with our operating partners team to, in 2022, we spend probably on 2/3 or 75% of our portfolio. We've run price increase studies and increase price in anticipation of the cost increase. We spend a lot of time with our capital markets team working on hedging our debt, making sure we don't take the full rate increase ahead of us. And so there's the beauty of doing buyouts is that you're controlling your environment. You're kind of mastering your own destiny. And so if you do that well, if you anticipate issues, you protect your portfolio. And therefore, yes, your earnings could be under pressure if demands collapse, but that's the only unknown is, where the market is heading. And if you back to the mega trends and the fundamentals of the business in which we invest, if you're serene in this ability to drive long-term growth, you don't lose your sleep over, major risk of, downturns and earnings reduction. So our portfolio has grown double-digit in 2022. And our budgets for 23 shows some pressure on the labor costs, but much less than we anticipated. I think the European market is different from the U.S. market. I think there's still a high level of unemployment. So it's more driven by fundamental commodity price increase, which are reducing now. So we see much less pressure on inflation, and therefore again the only unknown for 23 is how demand is going to be sustainable. And so far, we're just early into 23. We're reasonably confident that it's manageable.
Jeff, you have one of the foremost portfolios in tech services. Does the forward revenue visibility give you a lot of comfort at night? Help you guys sleep at night, knowing, listen, recurring revenue, I can see where bookings are going to come out for the rest of the year, so I got no problems?
So again, I'm building off of what Mark said, because how they think about their investments is very similar for us. First is obviously the key macro trends that he mentioned before. As long as we're aligned with those growth trends, then it's about finding the platform and the business model. So to your point, Sunaina, most of our businesses have a good degree of recurring revenue, so we've got a lot of the visibility for 2023 already spoken for. We feel pretty good about demand there. To your point, if demand starts to fall off, that's a big issue, but ultimately we feel pretty good about those long-term growth trends. And for us, given the vast majority of our businesses are services, B2B services businesses, personnel costs and wage inflation is probably the biggest one that we've been focused on. We get asked that a lot. And what we're investing behind is mission critical services. So it's not unusual for any of our customers to know that there's wage inflation that's going on there. And so frequently we're passing all of those costs onto our customers and being able to maintain our margins. So it's a huge important aspect for us. We underwrite that up front, and we make sure that there's resiliency and the mission criticality in those business models to be able to do so.
We have a few minutes left before we ask the audience if you have any questions for our panel here today. So I'd like each of you to talk about your big prediction for 2023 and also the biggest risk that you'd like all of us to keep in mind. So happy to open it up and hand it over perhaps to you, Mark. We'll go down
Okay,
the
well, I'm an optimistic in nature, so again, I think we're lucky to operate in an asset class that has been resilient through cycles, for many years and decades now, and again, there's fundamental reasons for it. So I'm definitely positive about 23 and further. My general prediction around the industry is that you can sense that the amount of effort you need to select the right asset, to grow the assets, and turn them into better companies requires a ton of effort in terms of human capital. The ability to bring business internationally, your ability to transform them digitally, to transform them from an ESG perspective, is a massive investment. More and more our businesses are being focused on sector expertise and deeper sector expertise. So that requires a lot of talent, that requires a lot of investment, and therefore I think there's a value for large platforms that can afford this type of transformation. So I think our industry will continue to consolidate, inevitably, because there's a rising cost to operate in our business. So that's my prediction.
No, thank you for that. Jeff?
Yeah, I was going to add on to that in terms of trends that we're seeing. Part of the beauty of wage inflation and some of the other inflationary costs is it's creating this significant demand and need for automation. And automation gets very closely related to digital transformation as well. So you're seeing a lot of those trends operationally. So that's one, obviously, continued prediction. And in addition to that, just given the fact that there's so much capital that's still on the sidelines, whether it's on the debt side or it's on the equity side, regardless of some instability and demand that's out there, folks, we have to deploy capital. And so I think you're going to see a lot more creativity this year, maybe not wholesale sales, because people realize there's still a lot of value to be had in their businesses. But structurings, structured deals or recapitalizations, I think you'll probably see that as people look to still deploy capital, but in ways that it's measured and you can still, collect some of that upside in the down.
I think this is going to be one of the best vintages as it relates to credit, but also to equity, in the sense that valuations are eventually going to come into line. It's going to make it a very attractive buying opportunity for private equity sponsors. And from a private credit standpoint, look, the banks at some point will come back online, but in the interim, we're very open for business. And what we do is to really partner with private equity firms to find creative ways of allowing them to structure their deals. And we'll continue doing that, whether it's with senior debt, unit tranches, or junior debt. I mean, there's a long list of products and tools that we can use to help them do that, which at the end of the day will just allow us to continue doing deals, whether it's credit deals or equity deals.
Great, and I'll add one to the mix before we open it up for questions. I think the private equity fundraising environment for the first half of 2023 is going to be spurred by a lot of capital coming from three sources: private wealth, which is still dialing up its private equity exposures; Middle Eastern investors, because they're dollar denominated and have seen a lot of inflows due to oil; and third, there's a set of investors in the US called hospital systems and endowments, who are looking to leg up their capital increases into private equity as well. So with that, would anyone have any questions for our panel or for any of us or all of us? Well, as you think of questions, I've got one more for you all. How are you pricing in, if any kind of rate backdrop of the rates going back down, which can then really sort of spur activity in the M&A world for both for your businesses and for deployment? Are you looking at that as a scenario that could happen at the back half of this year? And are you keeping any chips dry for that environment?
Well, that's a macro play that would bring upside, but we certainly would not, use that as a baseline scenario today. So, the answer is no.
Yeah, neither. For us, we continue to be conservative with how we underwrite with rates. Rates aren't a huge influence in our IRRs regardless. Even with rates having increased the rates they have, I think it's overall 3% of our overall cash flow for our whole portfolio. So it's a very small aspect of our IRs. And if they go down, that would be phenomenal for us. Maybe less so on the credit side for you, but it's more deals.
I mean, we've certainly benefited from the increase in the rates, but what I think is also interesting to note is that in historical times, when you saw an increase in the base rate, margins would tend to adjust. In this specific case, it hasn't been the case. So we're getting sort of the best of both worlds. We're getting the increased base rate and we're getting the high margins. If the base rates start normalizing again, we'll still be in a pretty good spot.
No, you're in a terrific spot, Antoine. There's no question about that. How about for Jeff and Mark, as you think about exit environment, obviously with the M&A markets being more challenged, still working, but certainly a flight to quality there. IPO markets are shut. Are you looking at alternative exit strategies like continuation vehicles, strip sales, other DPI increasing strategies in your portfolio?
Yeah, I think we did look at continuation fund. We launched one last year. I think the challenge for continuation fund, and it's interesting to get the audience feedback, but there's a ton of opportunity in the secondary market. There was in 2022. So for secondary funds to invest into a single asset deal at fair market value and paying fees and carried versus buying at a 20-30% discount diversified portfolios from institutional investors, that's a trade-off that is easy to make for them. So my sense is that continuation funds are much harder to raise these days. Might change when the market cool off a little bit. So this is part of the tools, and that's part of the innovation that we're seeing in the industry, which is good because there's a lot of assets that we like and where we see a new chapter that needs to be written. And we can take a company, on average, we triple the size of the assets in which we invest. So we can take them from a 50 million EBITDA business to 150 million EBITDA business. But at some point, you need to pass that on to somebody else. But if you're able to raise capital with a partner and continue to grow that business that you do very well, it's a win-win for everybody, our investors and us. So I'm a deep believer in continuation funds. Obviously, what we're looking for these days is more strategic investors, and back to the notion of backing the right assets and having the right selection process. If you have high-quality assets, they're attractive for strategic buyers, and they are still able to operate, and they're not dependent on the financing market and so on. So that's the route that we would be seeking. And what we're seeing as well in this market is probably less straight sales process and more bilaterals or fuzzy processes, and this is what we're going to see probably in 2023 still is some sort of informal processes, and you have to stay opportunistic.
Yeah, and same for us. We have a couple assets in our portfolio that we're lining up for exit this year. They're phenomenal companies, so we're just not, regardless of the market backdrop, we think they're going to be great outcomes for us, and they have strategic exits as well as PE. For continuation funds for us, it's an interesting equation because I think it just creates a lot more flexibility for the sponsor, and for us, we're not really thinking about that as an avenue for exit. For our businesses in reality, we're looking first at those companies to say, what is it we can do with these businesses? We've built conviction and we've built a relationship with this that, man, we see another 5-10 years of growth where we may have already tripled the business. Like you said, it's very similar metrics for us. We could probably triple it again in the next couple of years. That actually makes a hell of a lot of sense for a continuation fund, just given we can double down there.
Antoine, are you seeing more of a preference towards saying, listen, I could hold for longer if I can continue to add value in these businesses? How do you have those conversations with some of your sponsor partners?
I mean, they happen all the time. The reality is that when we like an asset, we tend to accompany the asset for 5, 10 years if there's an opportunity to do that. The discussions we have are, they can range from refinancings and recaps, which allow the sponsor to continue to create value and to extract value from the asset as we go along in time. Or they can be more creative things that we can also think about, including us coming into a continuation trade if needed.
I think we are right on the money on our time. Thank you all for listening. Hopefully it was useful, and we wish you a good rest of your afternoon.
Thank you.